Federal Reserve continues their tight monetary policy, putting pressure on equities, stressing bond markets, and increasing the burden of public and private debt. This Fed policy, along with mounting national debt, creates even more challenges and uncertainty for the ordinary investor and financial institutions. To help make sense of this present economic environment, we will hear from macro analyst and investor Lyn Alden, macroeconomist Gareth Soloway, and economist, White House advisor, and author Jim Rickards.
Financial markets can come up with their own narratives and go their own way, at least for a while. So they're not in sync. They will be in sync eventually, but not always right away. A lot of times the financial markets get ahead of themselves and then they wake up to reality and they, crash, correct down. So financial panics and recessions are two different things. They can come separately. In 1998, we had a financial panic, but there was no recession. In 1990, we had a recession, but there was no financial panic. In 2008, we had both. They can come together. It looks like they might be coming together again.
Mainly because of how much debt's in the system. And so if we back up a second, basically the Fed has, kind of two competing forces right now. So on one hand, they're the furthest behind in inflation they've been since 1951. And so they're in this kind of tough position where inflation says to hike and the economic growth rate says soften. And then the kind of the macro backdrop for this whole thing is that with federal debt to GDP well over 100% and private debt to GDP even larger, if they were to normalize to structurally positive real yields, the interest burden would be very massive on that debt. The last time we were in this position was back in the 1940s. That was the only other time the U.S. federal debt to GDP was this high, and you had a period of financial repression where they held rates low despite the fact that inflation ran hot because they had little other choice. With central bank tightening, strong dollar, we're starting to see some of that disinflationary pressures, and I think a lot of people assume that once that goes down, it's just behind us now. Whereas I think an issue is that inflation is ready to return should, for example, the Fed eventually pivot or get dovish in some way. Basically, as long as the supply side's unaddressed, it's ready to come right back.
In the late 1970s, the dollar was under so much attack and so much stress that Jimmy Carter actually borrowed in Swiss francs. The dollar was so unwanted and so in danger of collapse in the late 1970s that the United States had to go to the marketplace, and we issued Swiss franc bonds. They were called Carter bonds. So, and remember, that was a period of high inflation from 1977 to 1981. Inflation in the United States in those 5 years was 50%, 50. The value of the dollar was cut in half in just 5 years. So, but investors need to look forward. I call it the curse of the 2-second attention span. People worried about what's happening today or tomorrow. Well, that's fine if you're a day trader, but if you're an investor, you're worried about your retirement, you're worried about wealth, your children's well-being, etc. You ought to be looking a little further down the road. It's a little bit like fire insurance on your house. You don't want your house to burn down, but heaven forbid if it does, you're sure glad you had the insurance. And when you write that premium check to the insurance company every month, you don't think you're throwing your money away, you think you're doing a smart thing. So get some gold, it's volatile, don't get too upset with the day-to-day price action. But institutional allocations are about 1.5%. So I'm recommending 10, so there's a long way to go there. People need to get a lot more gold.
I love to compare gold with the inflation periods that we're in now versus the 70s and 80s. And what's fascinating is that in the early 70s, before that high inflation hit, gold had this beautiful run from about $50 to $175. And in 1975, when inflation was roaring in the US, gold actually had this period of consolidation that lasted 1 to 2 years. Now, by the late 70s, 77 or so, you started to have a mega move where gold went from about $100 all the way up to about 800 or so. So, well, there's a certain amount of price action that it takes for that metal to get the money flow to go in and start chasing it higher. And it's absolutely, in my opinion, replicating the price action from the 70s into the 80s.
The first great bull market was 1971 to 1980. It lasted 9 years and gold went up 2,200%. The second great bull market was from 1999 to 2011. Gold went up at just a little under 700%.
As the Federal Reserve props up the strength of the dollar with high interest rates, this lowers the price of gold. This is the opportunity. With the eventual Fed pivot and inevitable money printing, gold will rise. To paraphrase the famous hockey player, Wayne Gretzky, I skate to where the puck is going to be, not to where it was. If you are interested in protecting and preserving your wealth with physical, precious metals such as gold and silver, whether in the form of private investments or a gold IRA, see the links in the video description to see the best gold IRA and precious metal investment companies that we have personally researched and vetted. Thanks for watching.